Hi, this is Amin, a California-based registered investment advisor. This weekly podcast gives you a snapshot of what's happening in the markets, breaking down important stories and explaining the forces driving them. Each episode not only covers what moved markets, but digs into why it matters, explaining financial concepts, and sharing practical insights to help you understand and prepare for what's ahead. It was a holiday-shortened week, but there was plenty of news flow. Here's what shaped the markets. First, all eyes were on the August unemployment report. People paid close attention because July was disappointing. Only 73,000 jobs were added, the weakest in years, and big revisions erased over 250,000 jobs from the prior 2 months of data. The Federal Reserve, America's central bank, wants stable prices and strong employment, but its recent interest rate hikes to control inflation may have slowed job growth too much. The August report wasn't reassuring. Just 22,000 new jobs were created, far fewer than expected, and the unemployment rate jumped to a 4-year high. Even more concerning, new figures showed the economy lost 13,000 jobs in June, the first decline since 2020. This suggests the job market and economy are weakening, and most analysts now think the Federal Reserve will cut interest rates in its September meeting, with total interest rate reductions of 0.75 of a percentage point now expected by year end. Lower rates should make borrowing cheaper for businesses and families, boosting spending and help prevent a deeper economic slump. The second major story was a jump in global long-term interest rates for government bonds in countries like the United Kingdom, France, Japan, and the US. Rates rose because investors are increasingly worried about rising government debt and doubt whether countries will manage their finances responsibly. The UK was at the epicenter, with yields on 30-year bonds reaching a 27-year high of 5.7%. The government had to offer higher rates to attract buyers as concerns about economic growth mounted. Rising rates make it more expensive for governments, businesses, and households to borrow, which can slow down the economy. Finally, the U.S. Court of Appeals ruled most tariffs set by presidential emergency powers were illegal, since only Congress has the authority to impose taxes and tariffs. For now, these tariffs stay in place while the administration appeals to the Supreme Court, with a decision expected mid-October. If the Supreme Court upholds the ruling, U.S. companies could get refunds on billions in tariffs paid. But this also creates short-term uncertainty about how businesses plan for imports and supply chains. Markets reacted with confusion and volatility, since trade policy and planning may change depending on how the court rules. For some context, when Chief Justice John Roberts decided on the Affordable Care Act back in 2012, he said only Congress can set taxes, a view that may influence the upcoming tariff decision, since tariffs function similarly to taxes. However, Congress has delegated tariff authority to the president, making the legal debate complex. The Supreme Court's ruling will impact both the economy and markets regardless of the outcome. Next week, the August inflation reports come out and are important because they'll help guide the Federal Reserve's decision about rate cuts in September, especially after the weak job numbers. The Consumer Price Index, CPI, tracks what people pay for everyday goods, and the Producer Price Index, PPI, looks at costs for businesses. These reports matter because the Fed needs to balance controlling inflation, which is still above its 2% target, with supporting the struggling job market. Finally, let's take a moment to look at a special topic: how the current boom in artificial intelligence, kicked off by ChatGPT in late 2022, is a lot like the internet boom of the late 1990s, which started around 1995 with the launch of Windows 95 and the Netscape IPO. In both cases, a new technology promised to change everything and led to huge amounts of investment, including major spending by companies on the necessary equipment and infrastructure, like data centers and powerful computer chips. However, there's a big difference in who is driving the boom now compared to then. The 90s dot-com bubble was fueled by tons of brand new startups, many with no real profits or track record, and a lot of them failed spectacularly when the bubble burst in March 2000. In contrast, the current AI boom is mainly led and paid for by huge, already profitable tech companies, including Microsoft, Google, and Facebook, which have plenty of cash and proven business models. While this could mean the AI investment climate is more stable than the dot-com era, the lessons from that bust still matter. The potential burst in the AI market, where company values drop sharply, could still happen if AI fails to live up to sky-high expectations, or companies can't prove they can make a real profit from their products. This could lead to a market correction that sorts out the truly valuable companies from the overhyped ones, just as the dot-com crash did for companies like Amazon and eBay. That's it for this week. Stay tuned for next Friday's episode with the latest market highlights, and don't forget to share your feedback using the details in the show notes. Click follow to automatically get future episodes, and please share with anyone who might benefit from these insights. Take care.